So, let's say Bobby did everything right, saved $70,000 through real discipline and sacrifice. But here's an issue he's not thinking about. Every single day that money sits in a bank, inflation is quietly draining its power. So instead of sitting in a train that's slower than a bicycle, what if Bobby deployed a smarter, proven strategy? One that combines the elite strength of two powerful Fidelity ETFs with three carefully selected Charles Schwab ETFs to build a portfolio specifically engineered for consistent growth, true financial freedom, and generational wealth. And the best part? This is actually simpler than you think. In this video, I will show you and Bobby exactly why Fidelity Investments and Charles Schwab stand above the rest in ETF investing. I will reveal these exceptional ETFs and demonstrate how their combined strategy could be the game changer for true financial freedom. In addition, I will break down what makes each of these 5 ETFs uniquely positioned to outperform. And in the end, I'll reveal how a single one-time $70,000 investment strategically allocated across these 5 ETFs has the potential to grow into a portfolio worth over $9 million while simultaneously generating over $7,000 monthly dividend income. Yes, you heard that right. A portfolio worth over $9 million that generates over $7,000 monthly dividend income. Remember, this is all from a one-time investment of $70,000. Welcome to Investments Mindset, where wealth builders come to get inspired. Before we continue, please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Let's dive in. Firstly, let's discuss why the Fidelity and Charles Schwab ETF combination is a game changer. Most investors spend their entire lives searching for the perfect strategy, jumping from one trend to the next, chasing hot stocks, and hoping for a breakthrough that never comes. But what if the secret to genuine financial freedom wasn't about finding the next big thing, but about combining two of the most powerful time-tested investing institutions in the world? That's exactly what a strategic combination of Fidelity and Charles Schwab ETFs delivers, and the results can be truly life-changing. Fidelity Investments has spent decades proving that disciplined investing wins over the long run. Through bull markets, recessions, and periods of extreme volatility, Fidelity has never wavered from its core mission, helping investors keep more of their money and compound it over time. Its commitment to low-cost, high-quality ETFs means that instead of leaking wealth through excessive fees, your returns stay where they belong, working for you. And that's not all. Now add Fidelity's deep research capabilities and long-term, growth-oriented funds, and you have a foundation built not just for growth, but for endurance across generations. Charles Schwab brings an equally powerful but complementary force to the table. From the very beginning, Schwab disrupted a fee-heavy industry by putting individual investors first, and that philosophy still drives every decision the firm makes today. Schwab's ultra-low-cost ETFs are among the most efficient investment vehicles available, ensuring that fees never quietly erode the wealth you're building year after year. Its seamless ecosystem of brokerage, retirement, banking, and research tools means you spend less time managing complexity and more time letting compounding do its work. But here's where the real magic happens. When you combine Fidelity's strength in dividend-focused and growth-oriented ETFs with Schwab's broad market exposure and unmatched cost efficiency, you don't just build a portfolio, you build a system. A system that generates reliable income, captures long-term appreciation, and manages risk without demanding constant attention. Fidelity and Schwab don't just complement each other, they amplify each other. This is the kind of investing strategy that doesn't just grow numbers on a screen. It replaces paychecks, it funds retirements, it breaks generational cycles. Next, let's talk about my special 4 pillars of a winning ETF investing strategy. In a world drowning in financial noise, separating high-performing ETFs from overhyped products requires more than instinct. It demands a disciplined, battle-tested framework. That framework rests on 4 non-negotiable pillars, and together they form the backbone of a truly powerful investing strategy. Let's check them out. Pillar 1. Consistent dividend yield. This is usually not flashy, just a reliable income that shows up quarter after quarter. Consistency signals financial strength and creates a dependable foundation you can actually build a life around. Pillar 2. Dividend growth. This is where long-term wealth quietly accelerates. ETFs growing dividends at 12 to 15% annually don't just increase income. They compound it, potentially doubling your cash flow every 5 years without adding a single dollar of new capital. Patience becomes power. Next is Pillar 3, share price appreciation. Listen, income means nothing if your underlying investment stagnates. The strongest ETFs grow through bull markets, corrections, and uncertainty alike, protecting purchasing power and steadily building net worth alongside your dividend income. Now, Pillar 4. Diversification across market segments. A resilient portfolio should span domestic equities, international markets, real estate, blue-chip leaders, and high-growth smaller companies. So when one segment slows, others keep the entire system moving forward. Master these 4 pillars, and ETF investing stops being guesswork and becomes a repeatable, wealth-building system. Now let's dive into these exceptional ETFs. Claiming the first spot on our list is the Fidelity MSCI Information Technology ETF, ticker symbol FTEC. If you believe technology will continue to define how the world works, grows, and creates wealth for decades to come, then Fidelity MSCI Information Technology ETF stands out as one of the most compelling ways to turn that belief into long-term financial power, because it offers instant ownership in the very companies driving cloud computing, artificial intelligence, semiconductors, software, cybersecurity, and the digital infrastructure that billions of people and businesses depend on every single day. This is not speculative betting on unproven startups or fleeting trends, but disciplined ownership of dominant, cash-rich innovators that sit at the core of the modern global economy and consistently reinvest in growth, scale, and technological leadership. What makes FTEC especially powerful is that it combines this high-impact exposure with exceptional cost efficiency, allowing investors to keep more of their returns compounding year after year rather than losing them to excessive fees, which over a 20 or 30-year horizon can quietly translate into tens of thousands of additional dollars in wealth. Its performance history reflects the unstoppable momentum of technology leadership. And while all investing involves risk, the long-term forces behind this sector, which include artificial intelligence expansion, digital transformation, cloud adoption, and global connectivity, strongly suggest that technology is not slowing down, making FTEC a foundational holding for investors serious about growth, resilience, and future-focused wealth building. Well, as the saying goes, numbers don't lie. Let's dive into the numbers for FTEC. The calculation is built on the future value formula. In this formula, FV represents the future value, which is the projected worth of the investment at a future point in time. PV stands for present value, which is the initial amount invested, in this case, $20,000. The variable R represents the total annual rate of return expressed as a decimal, and N represents the number of years the money remains invested and compounding. The entire logic of this formula rests on the idea that returns earned in one period are fully reinvested through DRIP. Let's check out the 10-year milestone. At the 10-year mark, the formula is applied as $20,000 multiplied by 1.2064 raised to power 10, meaning the 1.2064 multiplier is applied 10 times in succession to reflect 10 full years of compounding. This produces a portfolio value of about $130,626, representing growth of approximately $110,626 over the decade. The annual dividend income at this stage is calculated by applying the 0.44% dividend yield to the portfolio's current value of $130,626, yielding roughly $575. Next is the 20-year milestone. By applying the same methodology as the 10-year milestone, at 20 years, $20,000 multiplied by 1.2064 raised to the power of 20. The portfolio value would increase to $853,160. This figure illustrates one of the most powerful aspects of compounding. The portfolio does not simply double from its 10-year value. It grows by more than 6 times that amount. The annual dividend income at this milestone is $3,754, calculated once again as 0.44% of the $853,160 portfolio value. The dramatic increase in dividend income from $575 at year 10 to $3,754 at year 20 reflects that the same percentage yield is now applied to a much larger base. Now my favorite, The 30-year milestone. At 30 years, the calculation becomes $20,000 multiplied by 1.2064 raised to power 30, and the result is a portfolio value of $5,572,260. This represents a total return of over 278 times the original investment, and it demonstrates how compounding accelerates most dramatically in the later years of a long holding period. The annual dividend income at this stage is $24,518, which exceeds the original investment. I know this is fascinating, but stick around to see what a true definition of a resilient portfolio looks like. The next exceptional ETF is the Schwab US Dividend Equity ETF, ticker symbol SCHD. If there's one ETF that has earned an almost legendary status among disciplined long-term investors, it is the Schwab US Dividend Equity ETF. This unique ETF functions as a carefully engineered wealth-building system wrapped into a single, elegant ticker. It is built on quality and durability, selecting only financially strong American companies with long records of paying and growing dividends, healthy cash flow, manageable debt, and durable competitive advantages, which means it is designed not merely to survive market cycles, but to compound through them. What truly separates SCHD from most dividend ETFs is its rare ability to deliver income today while simultaneously positioning investors for growth tomorrow, as rising dividends and long-term share appreciation work together to create a powerful compounding effect that strengthens year after year. Rather than forcing investors to choose between stability and upside, SCHD harmonizes both, turning an initially modest income stream into a steadily expanding source of cash flow that can meaningfully support financial independence. Now, let's dive into the numbers of SCHD. This projection is based on a lump sum investment of $20,000. We are still using the future value formula, in which FV represents the future value, which is the projected worth of the investment at a future point in time. PV stands for present value, which is the initial amount invested, in this case, $20,000. The variable R represents the total annual rate of return expressed as a decimal, and N represents the number of years the money remains invested and compounding. The annual return rate used in this projection is 16.75%, comprising two distinct components. The first component is a 13.18% price appreciation rate, meaning the ETF's share price itself is assumed to grow at that rate annually. The second component is a 3.57% dividend yield, which represents the income distributed by the fund relative to its value. When expressed as the multiplier used in the formula, this becomes 1.1675, meaning the portfolio is multiplied by that factor once per year. Now, let's check out the 10-year milestone. At the 10-year mark, the formula is applied as $20,000 multiplied by 1.1675 raised to power 10, meaning the 1.1675 multiplier is applied 10 times in succession to reflect 10 full years of compounding. This produces a portfolio value of $94,105, representing growth of approximately $74,105 over the decade. The annual dividend income at this stage is calculated by applying the 3.57% dividend yield to the portfolio's current value of $94,105, resulting in $3,359 in dividend income for that year. Next is the 20-year milestone. Using the same methodology as in year 10, the portfolio value is projected to reach $442,789 at 20 years. The annual dividend income at this milestone is $15,808, representing 3.57% of the $442,789 portfolio value. The dramatic increase in dividend income from $3,359 at year 10 to $15,808 at year 20 reflects the fact that the same percentage yield is now being applied to a substantially larger base, demonstrating how reinvested dividends amplify income generation over time. Now my favorite, the 30-year milestone. Using the same calculation, $20,000 multiplied by 1.1675 raised to power 30, the portfolio value would yield $2,083,435. This represents a total return of more than 104 times the original investment and demonstrates how compounding accelerates most dramatically in the later years of a long holding period. The annual dividend income at this stage reaches $74,379, calculated as 3.57% of the portfolio value. This annual dividend income alone is nearly 4 times the original $20,000 invested, powerfully illustrating the long-term income-generating potential of a high-yield dividend reinvestment strategy. Before we continue, if you find value in this video, even just a little, please subscribe and hit the like button to help us continue to provide more insightful and educational videos. Your support is highly appreciated. Thank you. Next on our list is the Fidelity NASDAQ Composite Index ETF. Ticker symbol ONEQ. If you want a single ETF that fully captures the scale, depth, and momentum of innovation-driven wealth creation, Fidelity NASDAQ Composite Index ETF stands out as a powerful long-term holding because it goes far beyond the familiar NASDAQ 100 by providing exposure to more than 1,000 companies shaping the future of the global economy. This fantastic ETF is anchored by dominant, cash-rich leaders in technology, artificial intelligence, cloud computing, semiconductors, biotechnology, and e-commerce businesses with massive revenue engines, durable competitive advantages, and pricing power that is exceptionally difficult to disrupt, while simultaneously giving investors access to mid-sized and emerging innovators that could evolve into tomorrow's market giants. This combination creates a rare blend of strength and opportunity, allowing investors to benefit not only from today's established leaders, but also from the next wave of transformational growth that narrower ETFs often miss. By spreading exposure across the full NASDAQ ecosystem, ONEQ delivers meaningful diversification within the growth space without diluting its innovation-driven focus. Fidelity's commitment to low costs further amplifies its appeal, ensuring that more of your returns remain invested and compounding year after year, rather than being lost to fees. Now, let's dive into the numbers of ONEQ. This projection is based on a lump sum investment of $10,000. We are still using the future value formula, in which FV represents the future value, which is the projected worth of the investment at a future point in time. PV stands for present value, which is the initial amount invested, in this case, $10,000. The variable R represents the total annual rate of return expressed as a decimal, and N represents the number of years the money remains invested and compounding. The annual return rate used in this projection is 17.57%, which is composed of 2 distinct components. The first component is a 17.00% price appreciation rate, and the second component is a 0.57% dividend yield, which represents the income distributed by the fund relative to its value. Together, these 2 components produce a blended total annual return of 17.57%, which is the rate used in all calculations. When expressed as the multiplier used in the formula, this becomes 1.1757, meaning the portfolio is multiplied by that factor once per year. Now, let's check out the 10-year milestone. Using the future value formula, at the 10-year mark, the formula is applied as $10,000 multiplied by 1.1757 raised to power 10, meaning the 1.1757 multiplier is applied 10 times in succession to reflect 10 full years of compounding. The portfolio value would yield $50,464, representing growth of approximately $40,464 over the decade, more than a 5-fold increase on the original investment. The annual dividend income at this stage is calculated by applying the 0.57% dividend yield to the portfolio's current value of $50,464, resulting in $288 in dividend income for that year. Next is the 20-year milestone. Applying the same methodology as in year 10, the present value, $10,000, is multiplied by 1.1757 raised to the power of 20, and the result is a portfolio value of $254,660. This figure powerfully illustrates the accelerating nature of compounding. The portfolio does not simply double from its 10-year value, but grows to more than 5 times that amount over the second decade, mirroring the same multiplicative pattern seen in the first 10 years. The annual dividend income at this milestone reaches $1,452, calculated as 0.57% multiplied by the portfolio value. Now my favorite, the 30-year milestone. At 30 years, the calculation becomes $10,000 multiplied by 1.1757 raised to the power of 30, and the result is a portfolio value of $1,284,500. This represents a total return of nearly 128 times the original $10,000 investment, demonstrating how compounding accelerates most dramatically in the final stretch of a long holding period. The annual dividend income at this stage reaches $7,322, calculated as 0.57% of the portfolio value. Taking the next spot is the Schwab US Large Cap Growth ETF, ticker symbol SCHG. If long-term wealth creation is the objective, then owning America's most powerful growth companies is not optional, and the Schwab US Large Cap Growth ETF delivers that exposure with precision, scale, and exceptional efficiency by concentrating on the largest, fastest-growing, and most dominant businesses driving the US economy forward. This unique ETF is built on the proven reality that category-leading companies in technology, healthcare, consumer innovation, and communications have consistently created extraordinary shareholder value over time, not through speculation, but through overwhelming competitive advantages, massive market share, and the financial strength to innovate and expand through every economic environment. What truly elevates SCHG is its ability to reward patience, as it has demonstrated resilience through market downturns and volatility by recovering, adapting, and compounding capital for disciplined investors who stay the course. This durability is not accidental, but a direct reflection of the quality embedded in its holdings. Charles Schwab's commitment to ultra-low-cost investing further amplifies SCHG's long-term power, ensuring that fees do not quietly erode returns and that every invested dollar compounds at full force year after year. For investors focused on building generational wealth through disciplined ETF investing, SCHG is not merely a growth fund, but a high-conviction cornerstone designed to turn long-term belief into exceptional financial outcomes. Now, let's dive into the numbers of SCHG. This projection is based on a lump sum investment of $10,000. We are still using the future value formula, in which FV represents the future value, which is the projected worth of the investment at a future point in time. PV stands for present value, which is the initial amount invested, in this case, $10,000. The variable R represents the total annual rate of return expressed as a decimal, and N represents the number of years the money remains invested and compounding. The annual return rate used in this projection is 18.67%, which is composed of an 18.17% price appreciation rate and a 0.50% dividend yield. When expressed as the multiplier used in the formula, this becomes 1.1867, meaning the portfolio is multiplied by that factor once per year. Let's check out the 10-year milestone. At the 10-year mark, the formula is applied as $10,000 multiplied by 1.1867 raised to power 10, meaning the 1.1867 multiplier is applied 10 times in succession to reflect 10 full years of compounding. This produces a portfolio value of $55,408. The annual dividend income at this stage is calculated by applying the 0.50% dividend yield to the portfolio's current value of $55,408, resulting in $277 in dividend income for that year. While this dollar amount appears modest given the low yield, it is important to understand that this figure is not fixed. It grows in proportion to the portfolio in each subsequent year. Next is the 20-year milestone. At 20 years, the same formula is applied as $10,000 multiplied by 1.1867 raised to power 20, which is equivalent to taking the 10-year result and compounding it for another full decade. The result is a portfolio value of $307,005, crossing the $250,000 threshold and representing more than a 30-fold increase over the original investment. The annual dividend income at this milestone reaches $1,535, calculated as 0.50% of the $307,005 portfolio value. Now my favorite, the 30-year milestone. At 30 years, the calculation becomes $10,000 multiplied by 1.1867 raised to power 30, and the result is a portfolio value of $1,701,300. This represents a total return of more than 170 times the original $10,000 investment and stands as the most striking illustration of what a high appreciation rate combined with full dividend reinvestment can produce over a long time horizon. The annual dividend income at this stage reaches $8,507, calculated as 0.50% of the portfolio value. Claiming the final spot is the Schwab International Dividend Equity ETF, ticker symbol SCHY. This exceptional ETF is a hidden gem every serious investor should consider. While most investors remain narrowly focused on domestic markets, truly resilient long-term wealth is built by tapping into the full power of the global economy. And the Schwab International Dividend Equity ETF does exactly that by delivering high-quality international dividend exposure in one remarkably efficient vehicle. This fantastic ETF applies the same disciplined, quality-first philosophy that has defined Schwab's most respected dividend strategies, selecting financially strong international companies with proven dividend histories, sustainable cash flows, and durable competitive advantages, rather than simply chasing high yields. The result is ownership in world-class businesses across developed and emerging markets that generate reliable income while expanding your opportunity set far beyond U.S. borders. What makes SCHY especially powerful is its role as a true portfolio stabilizer, as international markets often move differently from U.S. equities, allowing SCHY to provide income and balance during periods when domestic holdings face pressure. This diversification strengthens portfolio resilience, smooths volatility, and reduces dependence on any single economy. The added layer of international dividend income further accelerates cash flow and enhances long-term compounding when paired with domestic ETFs. Combined with Charles Schwab's commitment to ultra-low costs, SCHY becomes an exceptionally efficient tool for global wealth building. Now, let's dive into the numbers of SCHY. This projection is based on a lump sum investment of $10,000. We are still using the future value formula, in which FV represents the future value, which is the projected worth of the investment at a future point in time. PV stands for present value, which is the initial amount invested, in this case $10,000. The variable R represents the total annual rate of return expressed as a decimal, and N represents the number of years the money remains invested and compounding. The annual return rate used in this projection is 19.08%, comprising two distinct components. The first component is a 14.59% price appreciation rate, meaning the ETF's share price itself is assumed to grow at that rate annually. The second component is a 4.49% dividend yield, which represents the income distributed by the fund relative to its value. When expressed as the multiplier used in the formula, this becomes 1.1908, meaning the portfolio is multiplied by that factor once per year. Let's check out the 10-year milestone. At the 10-year mark, the formula is applied as $10,000 multiplied by 1.1908 raised to power 10, meaning the 1.1908 multiplier is applied 10 times in succession to reflect 10 full years of compounding. This produces a portfolio value of $57,330, representing growth of approximately $47,330 over the decade, nearly a six-fold increase on the original investment. The annual dividend income at this stage is calculated by applying the 4.49% dividend yield to the portfolio's current value of $57,330, resulting in $2,574 in dividend income for that year. Next is the 20-year milestone. At 20 years, the same formula is applied as $10,000 multiplied by 1.1908 raised to power 20, which is equivalent to taking the 10-year result and compounding it for another full decade. The The result is a portfolio value of $328,700, representing more than a 32-fold increase on the original investment and crossing the $300,000 threshold. This figure again illustrates the accelerating nature of compounding. The annual dividend income at this milestone reaches $14,759, calculated as 4.49% of the $328,700 portfolio value. The dramatic increase in dividend income from $2,574 at year 10 to $14,759 at year 20 is a direct reflection of the high yield being applied to an increasingly large base. Now, let's discuss the 30-year milestone. Using the same methodology, the calculation becomes $10,000 multiplied by 1.1908 raised to power 30, and the result is a portfolio value of $1,884,000. This represents a total return of nearly 188 times the original $10,000 investment and is the culmination of 3 decades of compounding working simultaneously on both the price appreciation and dividend reinvestment components of the total return. The annual dividend income at this stage reaches $84,592, calculated as 4.49% of the $1,884,000 portfolio value. This figure is extraordinary in context. The portfolio is now generating over 8 times the original investment in annual dividend income alone. As promised earlier, it's time to check out the projection of the combined portfolio of these unique ETFs. This projection models the long-term growth of a $70,000 total lump sum investment spread across the 5 ETFs. Unlike the previous individual projections, which used each fund's historical return figures, this analysis deliberately applies relatively conservative annual return rates across all positions to produce a more cautious, grounded outlook for what the combined portfolio might reasonably achieve. We will continue to use the same methodology based on the future value formula. At the 10-year mark, the total portfolio value stands at $348,162, with a combined annual dividend income of $6,554. This represents a total return of approximately 397% on the original $70,000 investment, nearly a 5-fold increase in a single decade. And it demonstrates that even under conservative assumptions, the compounding of a diversified multi-ETF portfolio produces substantial wealth accumulation in the medium term. At year 20, the combined portfolio value reaches $1,739,490, with a total annual dividend income of $31,705. This represents a total return of approximately 2,385% on the original $70,000 investment, meaning the portfolio has grown to nearly 25 times its starting value. At 30 years, the combined portfolio value reaches $8,732,100, with a total annual dividend income of $153,822. This represents a total return of approximately 12,374% on the original $70,000 investment, meaning the portfolio has grown to more than 124 times its starting value under conservative assumptions. Depending on Bobby's location within the States, after taxes and other costs, he will still go home with over $9,000 every month. That, in my world, is the true definition of passive income. Now, remember that lasting wealth is rarely built through excitement or constant action, but through discipline, patience, and intelligent simplicity, which is why ETF investing remains one of the most powerful tools available to everyday investors willing to think long-term. Low-cost ETFs allow you to harness the growth of the global economy while letting compounding do the heavy lifting quietly and relentlessly over time. As Warren Buffett famously said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest, a reminder that time, not timing, is the true accelerator of financial freedom." If you're serious about building real wealth, then consider this channel your financial gym. Every video is a workout for your portfolio, your mindset, and your money skills. If today's video helped you level up your financial education, even just a little, please smash that like button and subscribe so we can continue to grow and build wealth the smart way. Please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Click on the next video on your screen. Thank you, my friend.